Are you wondering if you pay taxes on lawsuit settlements? If so, you're not alone. Settlement taxes can be confusing, and paying taxes on lawsuit settlements is a reality many plaintiffs face. So in this video, I'm going to walk through the tax implications of 5 common types of legal settlements so that you can be prepared for your own settlement. So for each case type, I'll explain the underlying tax law, because understanding the tax consequences of your potential settlement can make a huge difference in how much of your settlement you actually get to keep. I'm Greg Maxwell. I'm a settlement planning attorney and a certified financial planner, and I work with plaintiffs nationwide to help them figure out if they will have to pay taxes on their settlement. And if so, I help them do tax planning to pay as little in taxes as possible. Before we dive in though, please note, the information contained in this video is intended just for general informational purposes and is not intended to be tax advice. So I'll cover the taxation of 5 types of legal settlements in this video: personal injury, employment, defamation, legal, tax, or financial malpractice, and cases with punitive damages. After covering the taxation of each of these case types, I'll share some strategies that you can use to legally keep more of your settlement money and pay as little as possible in taxes. So make sure to stick around to the end. Personal injury cases. Let's start with the good news. If you settle a personal injury case like a car accident, a slip and fall, a dog bite, or a medical malpractice case, the compensation you receive for your injuries is generally tax-free. Section 104 of the Internal Revenue Code, the U.S. Tax Code, excludes settlement funds received for personal physical injuries and physical sickness. For example, if you get a settlement and you're being compensated for medical expenses, lost wages, pain and suffering, and loss of future earning capacity, as long as those losses stem from a personal physical injury, all the amount you receive is tax-free. This means you won't have to pay any income taxes on these amounts. That's good news. In most situations, you don't even have to report a personal physical injury lawsuit settlement on your tax return. So if part of the money you get from a personal injury settlement is for punitive damages, something we'll cover later in this video, you should know that this money will be taxed. So next, let's talk about employment cases. Settlements for employment cases are always taxable. So here's the big question in employment cases. Can you deduct your attorney's legal fees on your tax return? In some cases you can, and in some instances you won't be able to, and this can greatly impact your tax bill. So let's explore this further. Generally, if your employment case involves discrimination or retaliation because you are a protected class member, you can deduct your legal fees. So for example, if you were discriminated against at work because of your race, age, gender, disability, national origin, etc., you could deduct your legal fees above the line on your tax return. So thanks to this deduction, you would only pay taxes on the net settlement amount that you actually receive after paying your legal fees. So most employment cases qualify for the above the line deduction. So that's good news. But let's say you filed an employment lawsuit for harassment where your employer and fellow employees engaged in unwelcome behavior directed at you that was not necessarily based on any protected characteristic. So for instance, your employer spread malicious rumors about you or undermined your efforts to get a promotion. Or let's say in your employment contract, you were supposed to get a 5% bonus and your employer refused to pay that bonus, and you sued your employer for a breach of employment contract to recover your 5% bonus. In these scenarios, because the lawsuit isn't about you being a protected class member, the total settlement would be taxed, and you would not be able to take an above-the-line deduction on your personal tax return for your attorney's fees. So the Tax Cuts and Jobs Act of 2017 removed the miscellaneous itemized deduction for the tax years between 2018 and 2025. So there is often no way to write off attorney's fees at all. And this often leads to plaintiffs paying taxes on the full gross recovery, even if 30 to 40% went towards legal fees. So that would mean that if, for example, the total settlement amount was $10 and the attorney's fee was $4, you'd have to pay tax on the full $10, even though you only received $6. That is painful. All employment lawsuits are taxable. The question is whether you can deduct the legal fees paid to your attorney as an above-the-line deduction on your tax return. So if you get a settlement from an employment lawsuit related to you being a protected class member, you should be able to take the above-the-line deduction and only pay tax on your net settlement. If, however, your employment lawsuit is unrelated to being a protected class member, you will have to pay tax on the full amount of the settlement, including the amount paid to your attorneys. So spoiler alert, there are tax planning strategies you can use in employment cases to reduce your taxes, regardless of whether you can deduct your legal fees or not, which we'll cover later in this video. So defamation, libel, or slander cases. Defamation lawsuits, including claims of libel or slander, receive very harsh tax treatment compared to many other types of legal settlements. The entire settlement amount in a defamation case is considered taxable income, and this includes any damages awarded for emotional distress, reputational harm, lost profits, and punitive damages. So unlike employment discrimination or retaliation cases based on a protected class, plaintiffs in defamation suits cannot deduct their legal fees above the line on their tax returns. And again, due to the Tax Cuts and Jobs Act of 2017, there's really no way to avoid paying taxes on legal fees other than the tax strategy I outline later in this video. So plaintiffs in defamation cases who don't do tax planning pay tax on their full gross settlement, even if 30 to 40% went towards legal costs and fees. Okay, so settlements from legal, tax, or financial malpractice lawsuits also receive harsh tax treatment. The entire settlement amount is considered taxable income to the plaintiff. And after the Tax Cuts and Jobs Act, plaintiffs in professional malpractice cases are also unable to deduct legal fees on their own tax returns. And again, this results in plaintiffs paying taxes on the full gross recovery, even though a significant portion of the settlement went to paying legal fees and costs. So like defamation settlements, malpractice settlements face the double taxation whammy, where plaintiffs are taxed on the gross amount with no deduction for legal fees. So only using the tax planning strategy I cover later in this video can plaintiffs avoid an unfair tax hit in these types of cases. So what about cases with punitive damages? Well, any case with punitive damages is taxable. The tax code is clear that any punitive damage awards are fully taxable, even if the rest of the settlement is tax-free. So for example, a plaintiff receiving both compensatory and punitive damages for physical injuries would still need to pay taxes on the full amount of the punitive damages. The compensatory damages would be tax-free, but the punitive portion gets fully taxed. So in addition, just like in defamation or professional malpractice lawsuits, after the Tax Cuts and Jobs Act, plaintiffs cannot deduct legal fees related to punitive damages. And this results in plaintiffs paying taxes on the full gross amount of the punitive damages, even though a significant chunk goes towards legal fees and costs. The tax bill on punitive awards can be shockingly high. Okay, now that we've explored how 5 common case types are taxed, it's time to explore 2 tax planning strategies you can use before settlement to reduce how much you'll have to pay in taxes. So these 2 proven tax planning tools can significantly increase your after-tax settlement recovery. The first tool is called a structured settlement annuity. It works in all of the case types we've covered today. The second tool is called the Plaintiff Recovery Trust. The Plaintiff Recovery Trust is only needed in cases where legal fees cannot be deducted. So certain employment cases, defamation, professional malpractice, and cases with punitive damages. So let's take a closer look at each of these tools and how they can help reduce a plaintiff's tax bill. Structured settlement annuity. A structured settlement annuity allows plaintiffs to spread out the receipt of their settlement over multiple years, rather than receiving it all in the year that they received the settlement. So instead of taking the full settlement all at once, some or all of the settlement funds are used to buy a structured settlement annuity. An annuity takes the taxable lump sum settlement and parcels it out into customized regular payments over 3, 5, 10, or 20 plus years, whatever time frame the plaintiff chooses. So this setup enables the plaintiff to spread out their taxable settlement. And the plaintiff then is only taxed when they receive the annuity payments into the future. So why does this save on taxes? Well, because by spreading out the settlement, the plaintiffs then lower their marginal tax rate each year they receive those payments. So this results in significant tax savings compared to owing tax on the full lump sum settlement in 1 year at the highest tax rate. So in addition, the funds inside the annuity are earning a guaranteed rate of return, meaning the total amount paid to the plaintiff from the annuity is more than what they would have received via a one-time lump sum. So beyond tax-related perks, Annuities come with other added benefits. They provide guaranteed payments, which can even be lifetime payments, if that's what you desire. Finally, a structured settlement annuity and its long-term regular payments act as a safeguard to prevent the premature dissipation or spending of the settlement proceeds. So now let's talk about the Plaintiff Recovery Trust. For taxable settlements where attorney's fees cannot be deducted, like certain employment cases, defamation, professional malpractice, and any case with punitive damages, the Plaintiff Recovery Trust is a hugely important tax savings tool. So in these case types, the Plaintiff Recovery Trust is the only legal option that allows the plaintiff to avoid being taxed on legal fees that their attorney receives. Without the Plaintiff Recovery Trust, plaintiffs must pay tax on the full gross recovery, even the portion they pay to their attorneys as legal fees. With the Plaintiff Recovery Trust, plaintiffs only pay tax on the money they actually receive, which is the amount left over after paying their attorney's fees. So in our $10 settlement example, with $4 going to attorneys for their fees, the plaintiff would have to pay tax on the entire $10 if they do not use the Plaintiff Recovery Trust. With the Plaintiff Recovery Trust, the plaintiff would only have to pay tax on the $6 they actually receive. So in working with plaintiffs, we find that the Plaintiff Recovery Trust alone can double or even triple what the client ends up with after taxes. Okay, so let's revisit a few of our examples and some of our tax planning options. Now that we've shared how 5 common case types are taxed, and now that we've outlined how the 2 tax planning tools work, let's see how these could help plaintiffs in each case type scenario. So, in a personal injury case. So the first type of case that we discussed was a personal injury case. Does a structured settlement annuity help in a personal injury case? Yes, of course, but not for the reason you might think. As we discussed, the settlement is generally tax-free in a personal injury case. So a structured settlement annuity is not needed in that scenario to spread out taxation in personal injury cases like it might be in a taxable case. Why? Because there aren't any taxes on the personal injury settlement. So if you took a tax-free settlement from a personal injury case and put that money in a bank account or invested it in the market, any interest or growth you earn on those investments would be taxable. However, the IRS allows personal injury plaintiffs to place funds from their settlement into an annuity, and the interest and growth earned within the annuity are also tax-free when those payments are received in the future. Thus, the payments from a structured settlement annuity would always be 100% tax-free, even though the payments include investment growth inside of the annuity. So that's a unique benefit of a structured settlement annuity for personal injury plaintiffs. So does the Plaintiff Recovery Trust help in a personal injury case? Well, because the entire settlement is tax-free, there's really no need to deduct any legal fees. So as a result, you don't need the Plaintiff Recovery Trust in a personal physical injury case. The only exception is if there are punitive damages that are awarded as part of that personal injury case. Okay, so what about an employment case? The second case type we discussed was employment cases. Does a structured settlement annuity help in employment cases? Yes, employment cases are always taxable. A structured settlement annuity helps reduce a plaintiff's tax bill in taxable cases by spreading out the receipt of the settlement over several tax years, which lowers the plaintiff's marginal tax rate and therefore maximizes the after-tax recovery. So, does the Plaintiff Recovery Trust help in employment cases? Well, it depends. The Plaintiff Recovery Trust is not needed in employment cases in which the plaintiff is a protected class member, because legal fees are deductible in those cases. The Plaintiff Recovery Trust is only needed in employment cases where legal fees are not deductible. So, in employment cases where the lawsuit is not based on the plaintiff being a member of a protected class. So, in these non-protected class lawsuits, the Plaintiff Recovery Trust allows plaintiffs to only pay taxes on the portion of the settlement that they receive and not on the entire settlement, providing a huge tax savings. Okay, what about defamation cases? Well, the third case type we discussed was defamation cases. Does a structured settlement annuity help in a defamation case? Yes, because defamation lawsuits are always taxable, a structured settlement annuity reduces taxes, again, by spreading out settlement payments over multiple years. Rather than paying a huge tax bill if the settlement is received in one lump sum, the plaintiff pays taxes annually as they receive each annuity payment. Spreading out the settlement then results in much lower total taxes. Does the Plaintiff Recovery Trust help in defamation cases? Yes, because legal fees in defamation cases are not deductible after the Tax Cuts and Jobs Act. The Plaintiff Recovery Trust can be used to avoid paying taxes on those legal fees. In defamation cases, the Plaintiff Recovery Trust alone can often double what plaintiffs get to keep after taxes. So using both a structured settlement annuity and the Plaintiff Recovery Trust can often triple the after-tax recovery for defamation plaintiffs compared to receiving a lump sum settlement without any planning. So legal, tax, and financial malpractice cases. Well, the fourth case type we discussed was legal, tax, or financial malpractice cases. Does a structured settlement annuity help in these cases? Yes, absolutely. Because these types of malpractice cases are always taxable, a structured settlement annuity can help reduce taxes by spreading out the settlement recovery over several years. Does the Plaintiff Recovery Trust help in these cases? Yes. Legal fees in legal, tax, or financial malpractice cases are not deductible. Thus, the only way to avoid getting taxed on the amount paid in legal fees is to use the Plaintiff Recovery Trust. Using both the structured settlement annuity and the Plaintiff Recovery Trust can often triple the after-tax recovery for professional malpractice lawsuits. Okay, what about punitive damages? The last case type we discussed was cases that have punitive damages. Does a structured settlement annuity help in cases where there are punitive damages? Absolutely. Because punitive damages are always taxable, spreading the settlement over multiple years reduces the total tax paid significantly. Rather than paying a massive tax bill on a lump sum in the year you receive a settlement, the plaintiff can pay taxes over several years as they receive those annuity payments. Does the Plaintiff Recovery Trust help in cases with punitive damages? Yes, absolutely. Legal fees attributed to punitive damages cannot be deducted on the plaintiff's tax return. So without the Plaintiff Recovery Trust, the plaintiff will pay taxes on the total gross settlement, including the amount paid to their attorneys. With the Plaintiff Recovery Trust, the plaintiff only pays taxes on the settlement amount they actually receive. So plaintiffs receiving punitive damages can use both a structured settlement annuity and the Plaintiff Recovery Trust to dramatically increase, often triple, their after-tax net settlement. So there you have it. We covered the tax outcomes for 5 common types of legal settlements and looked at if we could reduce taxes by using 2 common tax planning strategies. The key takeaway is that while lawsuit settlement taxes can be confusing, there are ways for plaintiffs to legally minimize taxes and maximize their take-home recovery. So when used correctly, strategies like a structured settlement annuity and the Plaintiff Recovery Trust can literally double or triple the net amount plaintiffs get to keep after paying taxes. So we've covered a ton of ground in this video today, and I'm sure you can see why settlement taxes have so many plaintiffs worried and confused. But we're here to help. We're here to help you navigate the complexities of settlement taxation. If you're receiving a settlement soon and you want to keep more of your hard-won settlement proceeds, my firm is here to help you. We offer a free, no-obligation 15-minute phone calls for plaintiffs nationwide. To book your consultation, you can visit amicusplanners.com/call, or you can find a link in the comments or description. We'll provide a 100% customized roadmap showing how much extra money you could net if you implement the tax planning strategies I outlined. Even if you don't move forward with our firm, you'll walk away with invaluable education on reducing your settlement taxes. In the meantime, check out our proprietary, free settlement tax savings calculator at settlementtaxcalculator.com. This calculator will estimate how much you'll pay in taxes, and most importantly, it will show you how much more money you can keep by using one or more of the strategies I mentioned in this video. So please don't wait to reach out, since all of the tax planning strategies I covered today must be set up before you receive the settlement. If you wait until after settlement, it's too late, and there's not much we can do to help you. So thank you so much for watching, and I look forward to speaking with you soon.